In this video we're going to move on to the income statement. So last video we looked at the cash flow statement as part of the overall monitoring and controlling process. So remembering the cash flow statement is all about measuring the cash into the business, the cash out to the opening cash balance plus cash into the business over the defined period. So we were looking at a month to month cash flow cycle, cash out of the business, and then what's the closing cash balance at the end of that relevant period. Now we're going to move on to the income statement. The income statement has a number of names, which is referred to at the bottom of this slide. Those names are profit and loss statement and revenue statement, or statement of financial performance. And as that name suggests, the last one, the statement of financial performance, it shows the operating results for the business over a period of time. And those effectively relates to the revenue earned by the business in the form of sales and the expenses incurred by the business. So it gives information on their sales, so their headline, the top line in your income statement are your sales figures. So how much in terms of dollars did we make in sales for the business over the defined period of time, which is generally 12 months. What were our cost of goods sold? So our opening stock plus purchases minus closing stock. What were the costs for the business? What was the gross profit? And therefore, ultimately, what was the net profit and or loss? And I'll go through this on an example in a moment. So remembering that cost of goods sold, so what did it cost the business to be able to make the goods that it sold? And that is your opening stock, because that's what you're selling, your opening stock plus purchased stock or purchases over the course of that period minus the closing stock for that business. And that is your cost of goods sold. Okay, so here's an example of, again, using the same company, and we've looked at this in class before. So looking at I Wish Toys. So let's look at some of those key items that we were just referring to. So for this business, their headline number, their revenue or their sales item, I Wish Toys for the period ending 30 June 2015. And it's very important that you recognise that an income statement is always for the period ending. They made $630,000 worth of sales in that 12-month period. So from the 1st of July 2014 to the 30th of June 2015, they made $630,000 worth of sales. Okay, then we need to calculate an income statement shows cost of goods sold. So what did it cost the business to be able to make these $630,000 worth of sales? Well, how do we work that out? Okay, well, we start with our opening stock. So at the 1st of July 2014, this business had $120,000 worth of stock. Over the course of the 12-month period, from 1 July 2014 to 30th of June 2015, they purchased an additional $210,000 worth of stock. But they didn't sell it all, because they had closing stock of $80,000. So that means at the 30th of June 2015, their stock was $80,000 worth, or they had $80,000 worth of stock. So what does that mean? It means that their cost of goods sold was their opening stock of $120,000 plus the purchases of $210,000 less that closing stock, meant that their cost of goods sold was $250,000. So effectively the business sold $630,000 worth in terms of sales, but it cost the business $250,000 to buy the stock that allowed it to sell $630,000 worth of sales. Okay, and what's the difference between the sales and your cost of goods sold? Well, sales minus cost of goods sold gives your gross profit. So for the 12 months ending 30 June 2015, this business made a gross profit of $380,000. Okay, but we've only considered costs from the perspective of the stock, but we must consider all our other expenses. So in this case, wages, phone, electricity, advertising costs, transport, some interest, all those other expenses that a business incurs as part of its general business activity or day-to-day running of this business. And their total expenses, if you add all those expenses up, came to $111,800. And so those expenses allow the business to calculate, well, what was its net profit? So its final profit, the profit really that all stakeholders, both internal and external, are really focused on. And that meant that our gross profit, less those additional expenses of $111,800, led to a net profit for this period of $268,200. So just to reiterate, the income statement is showing your total sales less your cost of goods sold, which gives you your gross profit, or which shows the business's gross profit, less all the other expenses that business incurs, will lead ultimately to calculating or a calculation of net profit. And that's really the profitability measure that is most closely looked at. And that is the income statement and the main characteristics of an income statement. And then next video we'll look at the last statement, the balance sheet.